Hi everyone, welcome back to the You Too Can Show with Octa. I'm your host, Ambrose Ebuka, and as always, I'm accompanied by my dedicated mentee and fellow trader, Tolu. Now, if you've forgotten why we're here or you don't know why we're here, Tolu and I have been exploring the world of Forex trading, aiming for her first $1,000 in profits. And today, we're embarking on an exciting journey into the realms of advanced trading strategies and risk management techniques. But before we continue, Tolu, how are you feeling today? And how do you feel about today's session?
I'm feeling good and I'm excited about today's session.
I feel good. That's amazing. Remember that every session is an opportunity for growth and learning. And as always, I'm going to be here to guide you every step of the way. All right.
All right.
Okay, Tolu. And everybody watching us right now, to all our viewers that are tuning in, whether you're a seasoned trader or you're just starting out, I encourage you to approach this episode and every episode that we've had or we're going to have with an open mind and a thirst for knowledge. Today, we're diving into some advanced topics that are crucial for traders looking to elevate their trading. We'll discuss different types of pending orders, market sentiment, and how to tackle pitfalls of fear of missing out, FOMO trading, through emotional discipline. But we're going to start with the first topic, pending orders and hedging strategies. Are you ready, Tolu?
I am pretty ready.
Before we go into that, quick disclaimer: any opinion, news, research, prices, analysis, or other information discussed in this training or linked to this presentation are provided as general market commentary and do not constitute investment advice. Today's session will be split into different sections. As usual, we have 3 sections today. We'll discuss types of pending orders, hedging, and events trading in the first section. We'll look at market sentiment analysis and Q&A in the second section. And we'll also look at FOMO and risk management tips in the third section. I'll wrap up with a Q&A and talk about what we have for the next session. So let's dive right in. Let's look at pending orders to start with. But before we do that, Tolu, remember that I gave you an assignment in the last episode, and I told you to map out zones of support and resistance on your chart and bring them over to this episode. Did you do that?
Yes, I did.
All right, go ahead and show me on the screen. Let's see. All right, so we have your support and resistance zone. Can you see my cursor right now?
Yes, I can.
Okay, so what's this level that you identified up here?
Resistance.
And what's this level you identified down here?
Support.
Do you notice that we also have a level that you didn't identify here?
Yes.
Oh, this level serves as.
This level is supposed to be a new support.
This level serves as support, right? So when you're identifying your support and resistance, you identify either from top to down. I prefer to start from down to the top, right? From your left to the right. You start from down to top. You can start from top to down, but I prefer to start from down to top. And you look at all these areas of support that you missed out on. You can see it here. You can see it here, here. You only got like this once. You missed out on this and this. And this served as a strong support level because if you look at this point, we also rejected here before we bounced down and broke through to still come back to retest for new resistance. So these are some of the points you missed out, some of the key zones you missed out on this chart. Let's start from this point. You missed out this, you got this too, and this one, you missed out on this. You missed out on this resistance, which created this breakout here and retest. You got this resistance. This could have been extended to this point as well because we have areas of market reaction here. You got this resistance, amazing. But you missed out on the extension of this support to this level where markets came to retest and consolidate at. We also have trend line support here that you also missed out on. So those are the areas you missed out on. But aside that, it was good. I see that you pointed some key levels of support and resistance. Let's look at the next one. This one is on Euro AUD. We have resistance here. We also have another one up here. You can use a horizontal line to map it out. So if you want to use the zones for your support and resistance, it can make it very big. And you don't want it that big. You don't want it that big. You just need it small, touch the key areas. Just like here, you can make it small, touch these areas. You don't have to worry about this breakout. You can use a line for this breakout, a horizontal line. But for the zones, just touch these major areas. And you see that you'll be able to extend that as a mirror level to this level here, these levels, this one, and this one as well. All right. But
Okay.
aside that, amazing. Good job. And let me know if you understand the corrections I made to your support and resistance zones.
Yes, I understand.
All right. Are you ready to get into the session now?
Just one quick question.
Okay.
Okay, so for this first support rectangle here,
Yeah.
so I can always ignore this line here
this,
that comes down.
This shadow, right?
Rejection. Yes, I can always ignore it.
So I didn't say ignore. I said you can use the horizontal box here for this one. Then use a horizontal line. It's just like this line. It's here. This line that you're seeing here. You click on it. You just draw it across there. You understand? So that except this happened in an area like this, then you can use the entire zone, no problem. But because this has already happened and we're seeing impacts of the market that you can extend to this point, it won't be ideal to just put a big horizontal box here. You can put it down here where you know that, okay, if this happened here, then this whole zone is valid to the downside. The market has not reacted to it yet. That's fine. But when you're looking at mirror levels, keep the mirror levels, simple. All right. Then you can use a line for this one, a horizontal line for this one, and extend to the downside.
Okay.
So are you ready to get back into the session today?
Yes, I am.
All right.
Meet Octa Trader, an innovative trading platform with a cutting-edge analytical feed, all in one to help you reach your investment goals. With one trading flow across all devices. How to start trading with Octa Trader? Download the Octa Trading app and sign up. Now proceed to create your real trading account. And once it's ready, make a deposit. Choose suitable payment method and collect your deposit bonus. But before you start trading, explore Space, a customizable trading feed where you can select assets to follow and choose topics that suit your interests best. Find relevant ideas for your trading style and gain confidence in your decisions to trade with profit. Give instant feedback on trading ideas you like. Get to trading seamlessly from the feed and open an order in a few clicks. You can also set stop loss or take profit right away. Create your own strategy with other built-in tools like our indicators and our drawing tools. Create your pending orders precisely. Set the desired price. Edit or cancel at any time. All your trading statistics in one place. You can get notifications across all devices to be up to date on all relevant market events. Now you are all set for trading with Octa Trader. Start today.
So today we're going to be looking at types of pending orders, and we have two main types of pending orders, the limit orders and the stop orders. And under these two main types of pending orders, we still have two types of pending orders as well, which I'm going to show you. First, look at limit orders, and I'll go ahead to define, and we'll look at the illustration. I'll show you what it looks like on the chart, but we're going to start with limit orders first. Now, a limit order is an order placed to buy below the market or sell above the market at a certain price. This is an order to either buy or sell once the market reaches the limit price. So for buy limits, you place a buy limit order to buy an instrument at a specific price below the current market price. For a sell limit, you place a sell limit order to sell an instrument at a specific price above the current market price. So buy limit you place where?
Buy limit below the current market price.
Sell limit you place where?
Above the current market price.
The stop order is an order placed to either buy above the market price or sell below the market price. The limit order, you buy below or sell above. The stop order, you buy above or sell below. You place a buy stop order. I think you should write that down. Limit order, buy below, sell above. Stop order, sell below, buy above. Write that down, please. You place a buy stop order to buy an instrument at a specific price above the current market price. So you see, you're placing the stop order above the current market price in anticipation that the price is going to get to your specific order and activate or execute. And for sell stop, you place your sell stop order to sell an instrument at a specific price below the current market price. You know what I'm going to do? I'll just go ahead and show you in my chart what it looks like. Give me a second. All right. So if you look here, you'd see that we have the market watch where we have the instruments to the side, and we also have the charts, the orders. Remember when I showed you about the windows and how to use them? Do you remember?
Yes.
Okay, so you can click on any one of these instruments. Click on pending order, and you can go ahead and put either sell stop or buy limits, or sell limits or buy limits, regardless of, depending on whichever one you want to put. Now, from the definition, let me show you. From the definition, let's start with the limit orders, right? So let's say we have the market price. I will label the market price with yellow. Is that fine? Or do you have any alternative color? All right.
That's fine.
Yellow works. Okay. Market price, right? We label this as market price. Then, remember, starting with limits, the buy limit order is an order placed where?
The buy limits below the current market price.
Below the current, which will be around here, right? So let's call this green. Is placed below the current market price in anticipation that, so I'm just going to go ahead. Let's look at what price do we have here. So let's say we want to place the buy limit order at let's say we want to place the buy limit order at 0.9030, right? So let's do that. Let's place the buy limit order. Pending order, buy limits 0.9030. We'll put our take profits for it. Let's say we want to take 20 pips, or let's do 50 pips. For example, our stop loss, let's say we want to do a 20 pip stop loss, so that would be 0.1. Place order. Now, you see that our orders will go to pending. You can see. Now, we've placed a pending order below the market price in anticipation that, are you with me, Tolu?
Okay, I can hear you now.
In anticipation that the market is going to go below the market price and activate your buy limit order. And for you to be in profit, where does the market have to go after activating your buy limit order? For you to be in profit, where does the market have to go? Up or down?
Down.
Down. Down is wrong. What order are you placing?
For
what
a
is
buy
this?
limit.
This is a buy limit order. So when the market activates, what does it react to?
Can you hear me?
I can hear you, yes. A buy limit order.
Okay. A buy limit order. And your question is, where does the market have to go for me to be in profit?
Yes, after activating, you can see that our buy limit is almost is close to activating right now. So for you to be in profit, where does the market have to go, up or down?
The market goes down for a buy limit order for you to be in profit.
So when you place a buy, where does the market have to go for you to be in profit? If you place a buy trade.
Is it when you place a buy or when you place a buy limit?
When you place a normal buy, where does the market have to go?
Okay, upwards, up.
So what's the difference between buy limit and normal buy? The difference is that it's a pending order. When the market gets to your buy limit price, it reacts to the initial instruction, which is what? What's the initial instruction? Buy or sell?
Buy.
Exactly. So what happens? What trade is executed for you? A buy or a sell trade?
A buy.
So where does the market have to go now for you to be in profit?
for buy limits, the market has to go down.
Why does the market have to go down for you to be in buy limits? Why does the market have to go down for a buy limit order?
Okay, so let me go with the definition of a limit order.
Okay.
The definition says that like placing trades to buy below or sell above the current market price.
Okay.
So if it's a buy limit, the market has to go downwards for me to be in profit, for me to be able to
No,
make
no.
profit.
I mean, after your buy limit has been activated, as the market is going down now, our buy limit is going to activate, and it has just activated, and you can see now that it has gone to open orders. So for us to be in profit, where does the market have to go, up or down?
I don't know.
When you place
Maybe
this is a buy
explain.
trade. This is a buy trade. Where does
Yeah.
the market have to go if you place a buy trade, Tolu?
Up.
Exactly. So where does the market have to go now?
Okay. Okay, so let me see if I understand what you're saying, what you're explaining. Can I like
Yes, yes,
rephrase?
please. Yes.
Okay, so a buy limit is placing a trade below the current market price in order to make profit. But once the trade has been executed, the market has to go upwards for the profit to be made.
Yes. Why does the market have to
Okay.
go upward?
Because it's a buy trade.
Exactly. It's a buy limit order. So the market is going to react to what comes first. Is it buy? Is it sell? Whatever it is there, it reacts to it. So do you understand buy limits now?
Okay.
Do you understand buy limits now?
Let me see. Once the order has been executed below the current market price, market now has to start going upwards.
Or a buy limit, because you can also
For
place
a buy
sell
limit,
stop.
yes.
Yes, you can also place a sell
Okay.
stop below market price, but it doesn't mean that the market will go up. For a buy limit,
Okay.
once the market executes below the market price, it has to go up for you to be in profit. As you can see, it's not going up, so we're not running in profit now. You place the sell limit where?
Above the current market price.
Above would be somewhere like, let's say here, which is the most recent swing. Okay, let's change this to red. So to be in profit, what does the market have to do? Market has to go up to your sell limit price, activate, and go where?
Then starts going down.
Starts going down. Beautiful. So that's how the sell limit order works. And remember that you can always set it from here. You can set it to sell limits, put the price above. Let's say, for example, we have 0.903. Once you type it, even if you're seeing buy stop, sell stop, don't worry about all that. Once you type in 0.903, you see your sell limit. Okay, you see the sell limit and you can choose which one you want, because there are only two orders you can place above the market price, either a sell limit or a buy stop. All right, you understand now how the sell limit works, right? We're going to go over buy stop. Do you understand?
I understand.
Okay, perfect.
Yes, I understand.
Hi guys, lots of you have seen those deposit bonuses that Octa offers. However, not all of you know what a bonus is and how to apply it. So let me guide you through the process. Watch this video until the end and grab your 100% bonus for more profitable trading. Let's go. The deposit bonus increases your equity and free margin. It helps you open orders with a bigger volume. So here's how it works. If you make a $100 deposit and apply a 50% bonus, you'll get $150 for trading. This way, you can open more orders with a bigger volume, potentially increasing your profits. Now, let me show you how to use it. Log into your Octa profile. Find the promo code section in the side menu. Enter the promo code U2CAN and tap Activate. Initiate a new deposit method and choose your preferred payment method. You can choose from instant bank transfers, Nigerian local banks, Skrill, Netseller, and many more. Claim your 100% bonus in the checkbox and complete the deposit process. And that's it. Now you know what a bonus is and how to apply it. Good luck. How does a buy stop work? I defined it for you and told you to write it down. So tell me, how does a buy stop
Okay,
work?
so a buy stop is, I just summarized it, like buy above current market price and sell below the current market price.
Buy stop.
Okay, just buy stop.
Yes, just buy stop.
Okay. That's buying above the current market price.
So current market price is here, right? You can see
Okay.
the orange line. Can you see
Yes.
that? So let's
Yes.
say I place an order here. What order did I just place?
A buy stop order.
A buy stop order. And what does the market have to do in a buy stop order? Get to my preferred price and do what? For me to be
Price.
in profit, what does it have to do? Where does it have to go, up or down?
I'm not sure.
So when it gets here, what order does the market activate?
Buy.
What does the market do when it activates a buy? Where does it have to go for it to be in profit?
Up.
You see that you know the answers
So,
to these things, but you just have to give yourself time to process it. Okay?
well, I wasn't too sure actually.
You
So
can
I
answer
place
me
a
if you're not
buy.
sure. Okay, let me tell you. The beautiful thing about questions is that you answer. You don't have to be sure. I'm here to tell you if you're correct or not, but just answer, okay?
So I place a buy stop order above the current market price. It executes and keeps going up.
For you to be in profit, yes. If it goes down, you will not be in profit. Because it's a buy. Remember, the market just gets to your preferred price and executes the first thing before the pending order. Is it buy stop? Is it sell limit? Is it buy limit, sell stop? What comes first? Buy. Okay, I'm buying. Simple. Do you understand?
So for sell order, I place
For sell stop, you place where?
sell stop order, I place below the current market price,
Okay.
and then I expect the market to keep going down in order to be in profit.
After getting to your
to my trade, to the trade I executed.
amazing. Do you have any questions on buy, stop, and sell? Well, buy, stop orders and limit
I
orders.
understand now.
So you understand perfectly, right?
Yes.
Okay, we're going to go to hedging strategies right now. All right, so let's look at hedging in Forex. Now, hedging is a risk management strategy that is used to protect ourselves as traders against unfavorable fluctuations in currency pairs. A trader can open a position in the opposite direction to hedge against potential loss from an order moving in the other way, while traders can also look at using hedging strategies to reduce possible losses while retaining market exposure. Hedging is basically placing buy and sell at the same time, or maybe not the same time, but placing a buy trade and still placing a sell trade on a particular asset or a cross asset. I'll go ahead to explain how it really works. But from this illustration, you see that you're placing buy and sells, and if in this illustration, you can see that the buy trade did not go in your favor. You close the buy, you can still make a profit from the sell trade, or you can close at break even, and break even means you didn't make any profit or a loss from that trade. All right, or you can allow the trade to run to make more profit, but that was possible by placing a sell trade after placing a buy trade. So that's how hedging works. That's just a basic illustration of how hedging works. I'll show you the types of hedging and give you an illustration on how it really works. So we have two main types of hedging. We have the direct hedging and the cross-currency hedging. Now, the direct hedging is when a trader is trading in the opposite direction of your current open trade. That's direct hedging. Cross-currency hedging is when you're trading a particular currency and you go to a different currency pair, which is similar to the one that you're being hedged, but not identical to it. So let's say in this example, for cross-currency hedging, look at this example, you see that a trader that is looking to hedge their exposure to Euro USD would decide to go long on USD JPY or short on GBP USD. Now, if you go long on USD JPY, which currency are you buying?
If you go long, you are buying USD.
Exactly. If you go short on GBP USD, which currency are you buying?
If you go short, you are buying GBP.
If you go short on GBP USD, which currency are you buying?
You are buying GBP.
So when you go short, is it a buy trade or a sell trade?
Sell.
So what are you selling?
You're selling GBP and buying USD.
So if you go short on GBP USD, which currency are you buying?
You're buying GBP.
Okay, let's do it again. If you go short on GBP USD, which currency are you buying and which currency are you selling?
If you go short on GBP USD, you're buying GBP, you're selling. If you go short, you're selling GBP and buying USD.
So now here's the question. If you go short on GBP USD, which currency are you buying?
If you go short, okay, which currency are you buying? You're buying USD.
Perfect. Now, if you go long on USD JPY, which currency are you buying?
You go long on USD JPY. Go long, you're buying USD.
So you see that if you go long on USD JPY and you go short on GBP USD, you're still buying USD on any of them, right?
Okay, yes.
Exactly. So this is cross-currency hedging. This way, you're hedging your exposure to the euro by using correlated currency pairs. For direct hedging, it's just like the example I showed you here. You're placing a buy or a sell simultaneously on the same or simultaneously on the same currency pair. Do you understand the difference now?
Yes, I understand.
All right, we're going to do some event trading and practice. So I'll go ahead and show you the economic calendar and we'll look at some of the events we have for the day. And I'll show you how you can capitalize on this event and brace up for them. Are you ready?
Yes, I am.
All right. So we are using the Octa economic calendar. As you can see, we don't have any high impacts. We only have medium and low impact events. You can always edit this and set it here. And let's see, we have one coming up, the European Central Bank's Lane's speech. You can always click on it. Richard Lane is an executive board member of the ECB, blah, blah, blah. And it's important to understand the speeches, understand and pay attention to what these board members or these governors are saying, because they would give you an idea of their stance on monetary policies and interest rates, which are also important for you. So what we can do, just because, give me a second, just because this is going to be coming up in many, many hours from now, what we can do, you can pay attention to the speech. And if you have any open trades on euro pairs, make sure your trades are secure and your stop loss is not so wide, just in case there's any wild movement. I don't expect much wild movements because it's a medium impact event, not a high impact event. Maybe in the course of this session, we would have a practice for live impact events that are going to be high impact events rather, and we trade that. But for now, no high impact event at the moment. So we'll just keep an eye on this one. All right, so we're done with the first section. If you have any questions, you can go ahead and ask me your questions now.
None at the moment.
None at the moment. Okay, we're going to go over to section 2 where we discuss market sentiment analysis and would have a Q&A session as well if you have any questions for me. So market sentiment analysis aims to assess traders and investors' general attitudes or moods towards a specific financial market, asset, or instrument. It seeks to comprehend the psychology of market participants, which may affect their decisions to buy and sell, and in turn, this would affect changes in price. What are the types of market sentiment? We have bullish sentiment and we have bearish sentiment. Now, in the bullish sentiment, the traders and investors feel optimistic about the market or a particular asset. They are more likely to buy or keep onto holdings because they think that the prices will rise. For a bearish sentiment, investors and traders have a pessimistic view of the market or a particular asset, and this is known as bearish sentiment. They may short sell assets in anticipation of price falls to profit from these moves. Bullish sentiment, investors and traders feel optimistic. They are more likely to hold on to an asset. Bearish sentiment, they feel pessimistic and they may short sell assets in anticipation of price falls to profit from the drop or the decline in an asset. When traders and investors lack a strong inclination towards bullish or bearish positions, it's said to be a neutral sentiment. So we also have neutral sentiment when they are not certain if it's going to be a bullish or a bearish market. They might take a wait and see stance until the market becomes clearer. Now, what affects market sentiment? Do you understand the different types of sentiments we have, Tolu?
Yes.
Okay, so what affects market sentiment? We have economic data, central bank, GDP growth, employment statistics, inflation data, and other important economic indicators can all affect market sentiment by influencing expectations regarding monetary policy and the economic state. We also have the geopolitical events by creating uncertainty and eroding investor confidence. Elections, trade tensions, geopolitical conflicts, policy changes. These are some of the geopolitical events that can affect market sentiment, especially when they are unexpected. We have corporate earnings as well. Investors' perceptions of individual stock and industries can be swayed by earnings reports and guidance, which would offer details on past performance and future expectations of businesses. We have news and media coverage, the mainstream media, which also go ahead to affect perception, sentiment, and sentiment-driven behavior. The news headlines, market commentary, media coverage, all that can influence market sentiment. Have you ever heard in the news when they say the dollar is increasing in value rapidly against the naira? Or have you ever heard that in the news?
Yes, I have.
You have? So what did you
Yes.
think? What did you think about that? What did you think about, the dollar is increasing? I don't know. I can't really say what the headline would have been, but I know that it has
Felt
to do
bad
with
because I knew that it was going to affect the markets,
the naira market or the dollar market. Which market?
the naira market.
The naira market.
Or should I say the Nigerian market?
Goods are going to be increased. Cost of living is
Yes.
going to be increased. Exactly. Because a huge amount of the foreign trade of the Nigerian market depends on the dollar. Now, let's look at the tools for analyzing market sentiment. So that's just exactly how, market sentiment of traders and investors can be affected and influenced. What are some of the tools for analyzing market sentiment? How do you analyze market sentiment? Fundamental analysis. You know how fundamental analysis works. You're looking at the financial, the economic, and qualitative aspects of an asset. You can use that to understand market sentiments. When you look at the macroeconomic trends, examine that. Look at the earnings reports and economic indicators. You can also look at chart patterns, technical indicators, price volumes, where you spot your trends, your support and resistance, reversal points. This can also help you and show you signs of mood swings in the market. We have sentiment indicators like surveys, polls, data, sentiment index, sentiment indicators. This can also give you a quantitative assessment of the market state. There's something called the COT report. You can also check that as well. There are also some good websites where you can look at sentiment, market sentiments from different traders and investors. We also have market breadth analysis. And this type of analysis looks at how different market participants act, behave, like volume patterns, sector performance, and the number of rising and falling stocks. So it gives you an understanding of the fundamental power or the fragility of market emotion. We have contrarian approach. Some traders and investors take a contrarian approach by defying the general attitude of the market. They seek opportunities to enter trades against the prevailing mood because they think extreme bullish or bearish sentiments can cause market reversals. So by taking a contrarian approach, you're going against the trend. If it's a bullish trend, you're going against the trend because most traders believe that when the market is overbought or when the market trends for a long time, there could be possible reversals. But it's very good to know that most times the reversal may be temporary, so you don't want to get caught up in a temporary reversal and the market continues to move in its initial direction. We also have confirmation approach, and these are the ways of interpreting market sentiment. We have the contrarian approach, which is going against the trend. We have the confirmation approach, which is going with the general feeling of the market, waiting for confirmation from fundamentals, from technicals, looking at the indicators, if you use indicators, looking at the final confirmation, which is candlestick momentum, getting that comfortability you need to execute a trade. So these are some of the two main ways of interpreting market sentiment. Do you have any questions?
No.
No question. So what is the final approach, or what was the final confirmation for executing a trade? I just said it right now.
Confirmation approach.
Yes, so what's the final confirmation? Under confirmation approach, let's say you're using technical analysis, you've used fundamental and technicals, and you want to be sure that your trade is ready to be executed. What's the last confirmation you look out for?
Mm-hmm.
You've drawn your horizontal line, support and resistance, look at the trend, it's ready. You've seen breakout and retest. You've seen a breakout and retest. What is the final thing you want to look out for at that retest?
Okay, last confirmation.
Yes.
Candlestick momentum.
Beautiful. Candlestick momentum is the final confirmation. Right about now, we're going to go to section 3, where we talk about risk management, and I'll give you some tips that can help you not fall victim to FOMO and also improve your risk management techniques. But before we do that, let me know, do you have any questions for me, Tolu?
No.
No questions. All right, we're going to go over to section 3 right now. Now, we've just talked about a lot of, advanced trading strategies, and it's important to use these advanced strategies, for traders that are looking to maximize profits. Tolu, can you hear me?
Yes, I can hear you.
So tell me, what advanced strategies have you been exploring lately?
Indicators, actually, especially
what indicators?
RSI.
RSI, okay, the relative strength index. And how has that been working out for you?
Well, I actually feel like it's how do I explain it now? It's not really giving me the result I want.
It doesn't give you the results you want, is that what you said?
Yes. Well, I'm still learning about RSI. I'm believing it's probably because I really do not know about it very well. But I use it a lot to see the direction in which the market is going. Most times it feels like should I say, the direction has been shown before. Like, how do I explain what I'm trying to say now? Normally, I'm expecting, okay, RSI should show me the direction in which the market is going. But most times, either maybe the candlestick just has formed, or the direction is already known before RSI is showing what it should show. I don't know if you understand what I'm saying.
Yes, I do. So I have to ask you, who told you that the RSI shows you direction of the market?
Oh, I probably assumed.
Or you just assumed? So most indicators
okay.
give, like, I'll say lag, because they already look at what's happening with the market and tell you. So for example, when the market moves to overbought levels, without the RSI, you might just think the market is moving up, but you don't know when it's overbought or oversold. So the RSI reacts to what the market has done. And that's what most indicators do. Even the moving average, all of them. Well, most of them, because there are some I don't know. So I don't want to just generalize. But most indicators give you results after the market has moved. Right? But you can use that as an added confirmation. Like if the market breaks above this moving average, if the RSI forms a divergence, those are additional confirmations, but you don't use them to know where the market wants to go. All right? Using the RSI is a beautiful tool. It's also important that you have a diverse toolkit of techniques. Moving average, you can add that. You can add the MACD and the Fibonacci as well to improve your entries. The Fibonacci most importantly. So now we're going to talk about FOMO. So Tolu, I have to ask you, have you ever felt compelled to enter a position because you were afraid of losing out on potential gains, if they don't move quickly?
Well,
okay, I'm asking because so. You have?
Yes.
When was that?
That was before this mentorship session started, though.
Oh, okay. The reason I'm asking is because we're going to discuss one of the biggest challenges most traders face, FOMO, and I'll show you how you can use discipline to overcome it.
You said the reason you're asking is because we're going to be what?
We're going to discuss one of the biggest challenges traders face, FOMO trading, and the role of emotions and discipline in overcoming it. All right?
Okay.
So fear of missing out, or FOMO, can make traders, or lead traders to make impulsive decisions based on emotions. And at the end of the day, with sticking to, or staying disciplined, sticking to your strategy, sticking to your trading plan, you can avoid FOMO. I'm going to go ahead and explain what FOMO is and how you can avoid it or overcome it. So FOMO, which stands for fear of missing out, is a psychological issue that can influence Forex traders. It happens when traders feel compelled to enter a position because they are afraid of losing out on potential gains if they don't move promptly. FOMO in Forex can cause traders to make hasty or irrational decisions that are inconsistent with their trading strategy or risk management principles. So let's say, for example, right? Can you see my screen?
Yes, I can.
Let's say, for example, you decide to use 2% as your risk amount. Let's say we have two imaginary traders, Michael and Kenneth. They both have $1,000 in their trading account. They place 8 trades, right? And after the 8 trades, the win rate is 50%. With multiple, and the risk to reward is 1:2. Can you see that?
Yes.
1:2 on each trade, right? Or let's say, yes, 1:2 on each trade. Now, Michael doesn't risk 1% or 2%. 1:2 here doesn't necessarily mean 1%. 1:2 means for everything you're risking, you want to go double. Now, you as a trader, you're the one that will decide, do I want my 1 to be 2%? Do I want my 1 to be 1%? Do you understand this ratio? 1:2
Yes.
doesn't mean 1% for 2%. It can be 2% for 4%. But what it basically means is that whatever is on this side, it has to be double on this side.
Double on the other side.
So Michael doesn't look at any of that. He just started risking $250. Kenneth chooses to risk 2% on his trade. Now, remember, the win rate was 50%, which means out of 8 orders, 4 were profitable, 4 were losses. 4 were losses, 4 were profitable. Now, the first 4 were losses. Michael, 250, 250, 250, 250. That's $1,000 loss. Now, he doesn't have any other money in his account to trade or to place the next trades, right? So his balance is 0. Kenneth risked 2%. He lost $20, 20, 20, 20, which is $80. Can you see that? And the next trades were profitable. So they made extra 4%. And he got 40, 40. Now the losses have been covered from just 2 trades alone. 40, 40. Losses have been covered. And the next 2 trades, or the last 2 trades, gave him an extra profit of $80. So this just goes to show you why having a proper risk management plan, using conservative lot size, using a moderate risk-to-reward ratio, and not over-leveraging is important. Do you understand that?
Yes, I do.
Okay, so right now we're going to talk about some risk management tips that can help you improve your trading. And for you guys watching as well, you can also put these tips into practice. This is going to help you really help you improve your trading abilities. First, you want to understand the market, get an adequate knowledge of the Forex market and the risk before trading. Understand the market properly. Second, you want to backtest new strategies on your demo account before trading on a live account, just like Tolu started from demo before going to a live account. You want to understand the impact of leverage. It's a two-edged sword. So you want to understand how you can use it to your favor while also protecting your trading account. You want to work on your risk appetite as well. Remember that your risk tolerance can be different from someone else's. So you don't necessarily have to look at people for your risk tolerance. Just risk little, 1 to 2%. It can be 1 to 2% for me can be $10,000. 1 to 2% for you can be 1,000, can be 100,000. So look at your risk appetite and create a plan that works in line with it. Use a moderate position size to keep your risk at minimal. Set preferred stop loss and take profit levels for your orders so that the market doesn't just take you all the way out and you blow your account. Protect your capital, which is very important with trading. And for take profits, protect your profits so the market doesn't reverse and you lose all the profits you would have made. Choose a moderate risk to reward ratio. 1 to 2, 1 to 4, 1 to 1 at least. Tolu, can you hear me?
Yes, I can.
Is 5 to 1 a good risk to reward ratio?
No.
Good. Use a trailing stop on your orders to protect your profit. Do you know what trailing stops are?
Trailing stops. No.
Trailing stop is when you place an order or a trade and your trade is in profit. Now, when your trade is in profit, you can move your stop loss into profit. So let's say you place a buy at 450 and the market gets to 470. You'll be in profit, right?
Yes.
And your stop loss was at 440. So you place a buy 450, stop loss 440. So let's say you place a trade here, right? Look at this red line. The red line is for the trade.
Okay.
Right here. And the market goes in profit. The market is moving like this. Boom, the market moves forward in profit. And let's change this so that you can know the difference. All right, so this one here is your stop loss. And this one here is your take profit, right? So the market is moving, going upwards. What you can do is almost at your take profit point. A trailing stop is putting your stop loss somewhere around here. Can you see that? You can only do this when your trade is in profit. You put your stop loss somewhere around here so that if the market reverses, what happens? It will close here. This is your stop loss level. So if it reverses and hits your stop loss, it will close there, but all these places will be secured for you. All the profit you made in this level will be secured for you. Do you understand? Yes.
Okay.
Exactly.
Yeah.
But if you leave it here and the market keeps going down, all the
Comes
profits
back to
that you'd have made here will be gone. And if it goes down, it will take you out and you'd have not made profit from the trade. So do you understand how the trailing stop works now?
Yes, I understand.
All right. Perfect. So would you be using trailing stops on your trades?
Yes, I will.
Okay. Control your emotions. Don't overtrade or revenge trade. Control your emotions. I have what I call the two, I call it the 2 equal to L or W rule, right? What that means is if I place a trade now, I can only place one, regardless of the outcome of that trade, right? If I place a trade and I make a profit, I can place another trade, right? I'm not saying if I place one trade, I can place 4 trades at once, but if I get into a particular market at a time and I make a profit, I can get in at another time in the same day, right? But if I get in at a time and I make a loss, I can still get it at another time in the same day. That makes it 2 times in a day, right?
Yes.
Now, if the first time, profit or loss, and the second time I make another profit, fine, I'm okay for the day. If I make a loss the second time, I'm okay for the day as well. I don't start to overtrade or revenge trade. Tomorrow is another day, okay? So you can also implement that and see how it works for you. Know when to stop after consecutive wins. It's not when you have a winning month, you start to feel like the master of the market and you start to go big and start losing your mind or feeling too happy and start to place, outrageous trades. Know when to stop after consecutive wins. If you have a trading plan, your trading plan is going to tell you that. And finally, never risk more than you can afford to lose. No more than 2% per trade. All right? Don't get too excited. Don't get too angry. Stick to your risk management plan, which I believe you have. You have a risk management plan, right?
Yes, I do.
So stick to that and you see how your trades would improve. Before I ask you these questions, do you have any questions for me?
No.
No. Okay. Well, you can always come back to this. If you have any questions, you can reach out to me and I'll be happy to answer your questions and teach you even more. So I'm going to ask you, what's a buy stop, Tolu? Let's take the questions. What is a buy stop?
A buy stop is an order placed above the current market price to above the current market price to be able to like get your preferred price, gets to maximize profit.
So what does the market do when it gets to your buy stop? What does the market have to do for you to make a profit?
Up. The market has to keep going up.
Okay, beautiful. Explain the 2 types of hedging strategy. I gave you 2 types of hedging strategy. How does it work? What are the 2 types and how does it work?
Direct hedging,
Okay.
cross-currency hedging.
Okay.
So, direct hedging is like trading in opposite direction. Like, let me see if I can give an example. Say you place the particular, like a buy order, but expecting the market to go up and the market is not going up. Then you end that trade and immediately you place a sell order for direct hedging. Can you hear me?
Yes. Okay, that's direct hedging. That's
Okay.
correct. There are
Yes.
also other ways to direct hedge. Okay, go on.
Okay.
Okay, you're going to explain
So
cross hedging. Okay, let me just finish with
Yes.
direct hedging. So
Okay.
it must not
Okay.
always be when the market is not going in your direction. Sometimes the market can go in your direction and you can start to see some pullbacks. You place a sell and close your buy and still profit from that. That's hedging. That's direct hedging. So tell me about cross hedging, please.
Okay, so cross currency hedging is like using 2 different pairs to achieve your aim. So for instance, you want to go, how do I explain it? So say you're working with Euro USD and then you
want to buy euro to sell USD?
Yes. And then you pick, say,
USD JPY.
Okay, so USD
So
JPY.
what will you do on USD JPY to still profit from USD or still cross hedge on USD? You can either buy or sell, If you want to still make a profit from the increase of both pairs, you can say, well, I'm buying Euro USD, I'm buying Euro to sell USD. I can sell USD JPY and still make a profit because the market is going to go in the direction of USD. Or I can buy Euro USD, which I'll be selling USD, and I could go ahead to also buy USD JPY just in case there's an increase in USD. All right?
Okay, yes.
Okay, final question. Name at least 5 risk management tips. Let's go.
Okay, so I'd say a moderate lot size.
Okay, moderate lot size, that's 1.
Yes. Always use stop loss and take profits.
Okay, that's 2.
Okay, control your emotions.
3.
Yeah. Get adequate knowledge, like adequate knowledge of the market and
what?
Okay, I'll say back testing. That's use
risk management tips.
Back testing is supposed to be
backtesting works under the knowledge of the market. So give me another one.
So it's like the same thing. Okay, so trailing stop loss.
Trailing stop is the final one. Amazing, yes. Amazing. You got your answers correctly. Hi guys. Lots of you have seen those deposit bonuses that Octa offers. However, not all of you know what a bonus is and how to apply it. So let me guide you through the process. Watch this video until the end and grab your 100% bonus for more profitable trading. Let's go. The deposit bonus increases your equity and free margin. It helps you open orders with a bigger volume. So here's how it works. If you make a $100 deposit and apply a 50% bonus, you'll get $150 for trading. This way, you can open more orders with a bigger volume, potentially increasing your profits. Now, let me show you how to use it. Log into your Octa profile. Find the promo code section in the side menu. Enter the promo code U2CAN and tap Activate. Initiate a new deposit method and choose your preferred payment method. You can choose from instant bank transfers, Nigerian local banks, Skrill, Netteller, and many more. Claim your 100% bonus in the checkbox and complete the deposit process. And that's it. Now you know what a bonus is and how to apply it. Good luck. So that's it for today, guys. I guess every one of you, including you, Tolu, need time to process this theoretical material, enhance your trading strategies, and then put this knowledge into practice. Remember, practice makes improvements. Keep learning and keep growing. Stay tuned for the next episode. In the next episode, we'll tackle more exciting topics in the world of Forex. We'll be looking at live trading session. We'll put everything together into practice and, just go over the charts and take some trades and potentially make some profits. While you're waiting for the next episode, join our Telegram channel with the link below. You would find some links in the channel to various educational materials, and you would also be able to connect to like-minded traders and become a part of a traders community. Until then, I'll see you guys in the next one. Take care. Take it easy. Bye, everyone.